So how do you know if a real estate deal is really a great real estate deal? So a friend of mine and a client actually was asking me this question recently. In fact, he was actually sharing with me how he is investing in real estate and has a very good rate of return. And he's doing a short-term buy and hold. They're holding somewhere around 3 to 5 years, and they're estimating that they're getting a rate of return at about 40%. So my question was, if you could have a rate of return that was double that, and there was no additional risk, you didn't have to take any additional risk, would you like to know about it, if that was possible? And of course the answer was yes, so I record this video today. Let's do some analysis on, number one, whether or not a real estate deal is in fact a good deal, and then number two, how do we actually make it a better deal? So let's take a look up here. We're going to use a software program called Truth Concepts, created by Todd Langford. Fantastic team. They've created just some awesome analysis tools that I use in my practice. So let's use Truth Concepts Real Estate Analysis. Now, I'm going to start with a pretty simple example, keeping the numbers simple. Of course, the numbers will be different for every deal, but let's just say we have a $200,000 property. And let's say that we actually were able to purchase the property for $200,000. I know that there are some that the property value might be higher and you've been able to purchase the property for less. But let's just say that they are identical, not $20,000 but $200,000. Let's say that the closing costs in this case were $5,000, and we're not going to list realtor fees because those are kind of nebulous. We don't know exactly what they might have been. Maybe the deal was closed on a for sale by owner. Any number of things can happen there. So when we come down here, we want to put in the land value. So what's our land value, which of course doesn't appreciate in the same way that a structure does. So we want to separate out our land value. And our basis for depreciation, we're going to keep it simple, $165,000. Now, in a standard purchase, especially if you have a number of loans out there, you're going to be on the hook for at least 20%, if not 25% down payment. So if we use a loan to purchase the property, we're going to have, let's say, a $160,000 loan. $160,000 loan, we're not paying any extra points. And let's just say that we end up with a 6% loan. Now I know today that we could get lower interest rates, but let's analyze this in a situation that maybe we've got a number of loans outstanding already. We're a real estate investor. It's harder for us to qualify for the really low interest rate loans. So let's say it was a 6% loan, and we're going to do 240 months. We're going to do a standard loan that way. With a 20-year loan, that's become very popular nowadays. So we end up with a mortgage payment, you see here, the mortgage payment of $1,146. Okay, so let's take a look at the next section here when it comes to property taxes. We've got our mortgage payment. Let's say we've got $200 a month in property taxes, another $200 a month in insurance. Let's say that we've got another $50 a month in maintenance. That we don't have any homeowners association fees on this property. Now let's come down here. We're going to put in the rental income. Now let's start at $2,600 and see what happens. So we get $2,600 in rental income. Now, is that possible on a $200,000 house? I don't know. I have friends and clients, people that I work with, that have some very high rental income on very low purchase price properties. So let's leave it there and we'll analyze that in a minute. Let's come down and also say that we've got a tax bracket. Let's say that we're in the 35% on our highest level. Let's say that capital gains taxes are at 15%. And let's say that depreciation recapture is at 25%. Now in this case, I'm not going to check off that we're a real estate professional. In order to be a real estate professional on your taxes, for tax purposes, you have to have very careful record keeping, 750 hours of actual real estate activity, you've got to have that documented, and if you don't want to be audited or lose an audit, you better have it documented correctly. So we'll leave that off. Let's go to the investment analysis. So we're looking at this with a 5-year hold. So let's analyze this over the course of 60 months. And for now, let's just put in that we don't have any property appreciation at all. We're not going to have any appreciation in the property. Now, you'll notice right off the bat, as soon as we put in the months that we want to hold the property, we have a rate of return down here at the bottom. The rate of return right off the bat now is 19%, 19.34. We've got to fill in a few more pieces here. Let's look at the years for depreciation. So the depreciation on real estate is actually spread out over 39 years. So we have monthly depreciation now that we're able to take on our taxes. And you'll notice that our rate of return jumped up to 21% now. Okay? And if we're looking to sell this property in 60 months, let's say that we've got sales charges and closing costs of $12,000. Okay, sales and closing costs of $12,000 comes off the bottom there, and you see that we've got a depreciation recapture tax of $5,200. And now, if you'll notice, we have just about an 18% rate of return. An 18% rate of return. Keep in mind, this is with no appreciation in the property whatsoever. So, based on this right now, this is looking like a pretty sweet deal. We're holding on to this thing for 5 years, and we've got an 18% return, even if the property doesn't go up in value. Now, what happens if we give it a rate of return? What if we actually get a 4% rate of return on the property? The property growth in value is 4%. Now we're up to a 26% rate of return. 26% rate of return. And the next question is, what if we can't get $2,600 a month in rent? What if we only get $2,000 a month in rent? Well, we still have an 18% return on this piece of property. So the numbers are compelling. You know, we have an 18% rate of return over this 5-year period holding this piece of property. What if we have a 5% growth in the property? Now we're up to a 20%. You see, so it's actually looking like a pretty sweet deal. But if you remember, my point was, or my question was, what if you could actually double or triple the rate of return? What if you could double or triple the rate of return? So here's the way we do that. Let's take a look at this. What if you come down here, and if you were able to borrow another $40,000 for a second mortgage? What if you were able to get that from a life insurance policy company or another source, and your cost of that loan, let's say $40,000. So now the first loan was the $160,000, and the $40,000, the remainder of the purchase price, comes from other people's money. One of the most important rules of real estate investing is never use your own money. So let's take a look and analyze that. So let's go get that $40,000 from somewhere else, like a life insurance policy loan. And 4.76% is the going rate on a life insurance policy loan, so I'm going to use that. Let's use the same term of years that we had up in the beginning that we're going to make payments back. And so there's our payment is $259 on that loan. And if you'll notice now, our rate of return now is 53%. 53%. What if we actually did get that $2,600 a month? Remember where we were. Let's go back just so you can see it. We get rid of that number. We're at a 26% return. If we got $2,600 a month on this property, we're sitting pretty nice. This is a good deal, even if we paid cash for the down payment. If we took our own money to put it in the deal, a 26% return is compelling. If we put someone else's money in the deal, we jump to 121% return by using other people's money. And in this case, if we're using a life insurance policy loan, our $40,000 remains in the life insurance account, earning dividends and interest, and it is not put into a real estate position for 5 years where it sits still, and it only earns a 4% rate of return. In this situation, it's clear that if you are a real estate investor using your own money for the down payments on properties to acquire long-term or short-term buy and hold, you're missing out on 100+% increase in your rate of return. Let's take a look, actually. What is the increase in that rate of return? So what I've done here is I've taken out the loan amount, this extra $40,000. Let's make sure that we lock this right here. Lock this number in your mind. We have a 26.42% return, 26.42% return on the money as it stands now, which is a pretty good deal. So now what we have to look at is we're going to bring in another calculator. I'm going to grab this, and actually what we'll do is we'll take this and analyze the actual return on the $40,000. So if we look at the 4.76% cost, and we're actually getting a 26.42% return in 1 year. So our actual, we're just using the 1 year as an example to calculate this, the return is a 455% return on the $40,000. Because remember, we bring in the $40,000, it costs us 4.76% to earn a 26% return, which is a 455% return on the $40,000. So here it is again. We bring in the $40,000. It cost 4.76% to earn 26% on that money, which brings our overall rate of return up to 121% return, because we're using other people's money to get that 26% return. This is Real Estate Investing 101. This is how the banks stay rich. This is how the billionaires and millionaire real estate investors stay rich, by understanding this principle. The key here is you have to have access to the $40,000. And in this case, as I mentioned, we're accessing this $40,000 from a life insurance policy loan so that we never stop the compounding effect on our own money. So in this case, the $40,000 is not coming out of our pocket, it's coming out of the life insurance company's pocket, and our $40,000 stays in there earning a nice rate of return. So there's Real Estate Investing 101. Use other people's money, take your return from 26% to 121%. If you have any questions, please look me up. You can find me on Facebook, LinkedIn. It's Kraig with a K, Strom, S-T-R-O-M, and look forward to hearing from you.